Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There continue to be some pending challenges for Rivian. Now, the company just announced that it made really good progress on Q2 production and deliveries. Looks like they're probably going to hit the 50,000 production number in 2023. But that's not nearly enough for the company to generate a profit. To get to profitability, the company is going to have to maintain high prices, increase volumes, and then even build another plant. With that in mind, there are 3 red flags that I see for Rivian that I don't think investors should overlook. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing. I got a link in the show notes, and I want to show a few things while I discuss the red flags that I see for Rivian. The first is what I see as increasing price competition in electric vehicles. This isn't only the case at Rivian. We've seen Tesla reduce prices. Ford has reduced some prices, both for the Mach-E and then for the Lightning XLT. What I think we're seeing across the board for electric vehicles is that premium pricing that we have seen for most of the past decade is really going away. And electric vehicles are really going to have to compete based on price alone. With that in mind, I think it's really interesting that the F-150 Lightning Pro starts at $60,000, whereas the Rivian starts at $73,000. Now, if you have been in these vehicles, I would argue that the F-150 is a significantly larger vehicle. And that's what makes it probably more compelling to a lot of buyers who are looking at a vehicle. That $73,000 for a Rivian R1T is actually very expensive. I've driven the R1S, and it's a very small third row SUV. So as more competition comes into the market, if they're coming in at lower prices, that's going to be a real challenge for Rivian, who really needs to keep this elevated price point. Now, they're trying to do things like introduce the dual motor, do other things to lower costs, but I don't think that Rivian is going to get to the point where they're going to generate positive margins with something like a $60,000 price point. A lot of these other legacy automakers in particular could do that because they can make their money elsewhere. That dovetails into the second thing, which is more competition just coming into the market. We have not even seen the electric Silverado come to market yet. That's still in the works. GM is ramping up their electric vehicle production. And we also haven't seen the ID Buzz, which would be more of a competitor to the R1S, but this is a 7-seat van type product. I think it's really compelling, but this is going to be something that buyers who are looking at an R1S are going to be looking at a Volkswagen ID Buzz. So as more competition comes into the market, it will put pressure on prices and potentially on volumes as well. And right now, Rivian needs to both keep prices high and increase those volumes as quickly as it can. So these are going to be 2 challenges that kind of work together against Rivian. On the growth front, we haven't heard a lot recently about the Georgia plant. Supposedly, Rivian is still thinking it can start production there in 2026, but there are still legal battles that are going on in the state of Georgia to pull out of some of the tax funding that has been given for the Georgia plant. Now, expect to hear more in the second quarter conference call, but this is one of those headwinds that I think ultimately could really be bad news for Rivian. I don't think the company can get to profitability with just the normal Illinois facility. They need to build a second facility, be able to produce a lower price point vehicle at higher margins. That means building this Georgia plant, and they need to get it up and running as quickly as possible. Now, the other question to go along with that Georgia plant is it going to be too late? By 2026, Tesla, General Motors, Ford, Volkswagen, every other automaker is going to be increasing their electric vehicle production really rapidly. There's going to be more competition on the market, more supply. If demand doesn't keep up with that supply, then it's going to be companies like Rivian who are feeling the pressure, because Rivian is not generating positive cash flow from any of its business right now. So I think this Georgia plant is really the key to the company's future, and I'm not certain that there's going to be enough demand for the product they're making 3 or 4 years from now. So the red flags that we've gone over today: pricing pressure, competition coming into the market, and then that Georgia plant just not coming online fast enough. Those are headwinds that I see for Rivian, but what do you think about the company and its current performance? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.